Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from WallBridge Mining Company Limited. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Brian Penny, Chief Executive Officer of WallBridge Mining Company Limited, which trades on the OTCQB venture market under the symbol WLBMF and on the TSX under the symbol WM. Welcome, Brian.
Thank you very much, and it's a pleasure to be here to introduce viewers to the WallBridge story, or for a long time shareholders to give you an update on our current situation. So, as the opening slide says, we're focused on the Abitibi. We're exploring in the northern Abitibi. As per every presentation, there's forward-looking information statements. I provide our cautionary language for all attendees. As far as our investment thesis, there's been many years of exploration in the southern Abitibi. Over $200 million of past production. In the northern Abitibi is recent finds, probably over the last 3 decades or so, and only 15 million ounces of past production. The challenge with exploring in the northern Abitibi is there's glacial overburden on top of the bedrock, and it's a little more difficult to find where the ore bodies are. We have 2 discoveries, one being Fenelon on the eastern side of our property, the second one being Martiniere. And the most important thing to remember, this is all on the same fault that connects the Detour Lake mine, which is Canada's largest gold mine, on the other side of the border. It's a district scale property. We have 830 square kilometers, 97 kilometers of strike length. Everything in blue is what we own 100% of. The white or grayish areas are either earn-in agreements with respect to the Casal property, which is in the center, and where Agnico is earning into the Detour East project, which is over to the left to the Ontario border. As indicated here, you can see our resource estimate as of mid-2023 or early 2023 adds up to about 5 million ounces on 4 million ounces on Fenelon and about 1.2 million ounces on Martiniere. A little bit of a history behind WallBridge. The major discovery happened in the first quarter of 2019. Ironically, the reason why we called it Area 51, it was the 51st hole we drilled into Fenelon, which we had the discovery hole. On that, we had a 10.5 square kilometer property position that was totally surrounded by Balmoral Resources. We entered into business combination and acquired Balmoral Resources, which is where the majority of our land position comes from. In November 21, we did our first resource estimate. Our decision at that point in time, we were looking at a large open pit opportunity, primarily at Fenelon. And as we learned more, we figured that the large open pit was not the way to go. When we did our updated resource in 2023 and our PEA, we focused on an underground bulk mineable scenario, similar to a young Davidson. It's our closest proxy. The ounces went up a little bit, but more importantly, the grade went up a little bit. And going forward with this project to focus on an underground opportunity versus an open pit opportunity, it helps with permitting timelines and other items that we have to deal with, our negotiations and our relations with our First Nations partners. In November of 2022, we sold all our nickel assets to a company called Archer Resources. We decided, the board management and the team decided that it would be best to stick to a single commodity. WallBridge had been around for 25 years or so. It started off as an explorer in the Sudbury Basin, and we moved those assets to a company that could advance them accordingly. Last year, we updated, as I mentioned, our MRE. We completed a PEA, a positive PEA on the Fennel Gold Project. We drilled about 50,000 meters with one new greenfield discovery, and most importantly, we achieved 5 years without a lost time accident. Our goals for this year, because of a little less funding, and the decision we were made when we were putting together our plans for this year was we could take Fenelon, do focus on infill drilling, take it to the next study level, but the money that we need to do that would be very dilutive to our shareholders. So it wasn't an opportunity. We looked at, do we put the whole thing in inventory for 12 months, but then we'd have no news flow. So we didn't go with that scenario. Where we landed is we raised a little bit of money, about $10 million of flow through last November to take us through the program this year. We came up with a smaller program so we can keep the news flow, keep advancing the project, keep working on some of the studies to advance the project. And most importantly, we set a goal because we're really excited about Martiniere, and we're looking to put together a combined PEA of the two projects in the first quarter of 2026. Focused on ESG, wherever we can, we're sourcing from the Abitibi region. We support business startups. We are publishing a new sustainability report later on this summer. We've committed to road improvements with the province near our facilities, and we look as much as possible to our service providers. About a quarter of our workforce is from our Indigenous partners. We have 2 signed PEAs with 2 communities, Waskaganish and Washarsibi, and we're working on one with Abitibi Winnie. And those are our 3 partners. So hopefully by the end of the year, we have pre-development agreements with all 3 communities. As far as our shareholder base, our largest shareholder is Eric Sprott, owning a little better than 16%. Agnico Eagle has been a long-time shareholder. Initially Kirkland Lake invested in WallBridge, but Agnico Eagle is maintaining that ownership interest. And William Day Construction, a Sudbury contracting firm, has been a long-time holder at 5.7%. The balance of the shares are held in retail and other. There may be some small institutions in there, but the vast majority of our shareholders are held by retail shareholders. You can see we closed the year with $29.8 million in the bank. As I said, that we're well funded for the current program, and we'll talk a little bit more as we go through this presentation. One of the biggest items our accomplishments last year was the publishing of our PEA. You can see the high level numbers, gold production over 200,000 ounces a year, strong annual cash flow, good all-in sustaining costs and total cash costs. Our NPV at a 5% discount generates a 18% rate of return. So a very good starting point for a PEA. Initial capital is $645 million, and life of mine, run of mine capital is $594, and these are all in Canadian dollars. And we'll talk a little bit more about that as we go through the presentation. When we put together the PEA, we went to first principles. Rather than taking a 7,000 ton a day mill that has been recently built, index it by inflation and say that's about what it's going to cost us, we broke it down into the component parts. We brought a mine contractor in to look at the initial ramp extensions to give us some solid numbers on that. And this was all done based on fourth quarter 2022 numbers, so it is quite current. And put all the sum pieces together, and then looked at it for reasonableness. And we'll come to that a little bit later on. As far as the capital allocation, you can see the breakdown between initial capital and sustaining capital. And one would say that usually your initial capital is not as close to the sustaining capital, but we plan on developing the underground through an underground ramp access. We will mine from the underground ramp access for 2 years to generate some cash flow. And then we will start sinking the shaft during the operating period. So it helps us manage the amount of upfront capital we need to raise to advance this project. The mining equipment, we're going to start off with a contractor in the initial phase and then move to an owner-operated fleet during this commercial production period. So that's why some of those numbers are, a little bit closer than one would expect. On the bottom table, you can see the breakdown of all of the unit costs that tie into the PEA, and the property does have a 4% royalty, underlying royalty on it. The whole analysis was done at $1,750 gold. That's the bold column there. But, at the time, we thought $1,950 spot was a great spot price. Today, it's much better. And you can see how the payback and IRR increase as gold prices go up. And we have not run any numbers about $1,950, but, clearly the economics improve as we go forward. And down below, you can see the sensitivities to changes in capital costs and operating costs. Moving back to our map on the property position we have, the next slide we'll go to and we'll talk a little bit about Fenelon. Fenelon, you can see our resource estimate in the bottom of the chart. In purple it's very tight. It is amenable to bulk underground mining, and we'll talk a little bit later on. And we do have a couple of drill holes at depth that indicates it continues at depth. But for now, we've got enough to start up, and we'll get back to that later on. If you look at one thing that excites me about the deposit and why we changed is you look at the ounces per vertical meter, and the initial plan was through an open pit operation, and you can see the ounces per vertical meter, and the first 400 or 500 meters was not that strong. It gets very strong in the mid part of the deposit, and then at depth it shrinks a little bit, but that's just because of lack of drilling. This year's program we're doing some drilling to fill in some of the gaps in the higher levels, but if you look at our ounces per vertical meter, comparing it to where Young-Davidson is, we have a similar strike length of 1.1 kilometers. It's a good proxy to say that, this makes sense. The engineering leads us this way. If we look at the closest proxy, it demonstrates that this seems to be the logical way to approve it. Yes, there may be a couple of small open pits on surface, but the bulk of the operation will be in this underground bulk mining scenario. Access to infrastructure. The blue line at the bottom of the slide shows you where the James Bay power line comes by. It passes the road into our mine site. It's about 25 kilometers of power line we'd have to build, but it's a great asset because we will have access to green energy, and going forward, as you finance opportunities like this, having the smallest carbon footprint as possible is prudent, and it helps you get financing opportunities across the line. We've already applied for an allocation. It'll probably take 2 years before we get a response, but we thought it was prudent to get into the queue, and as we learn more, we'll be able to advance that process. Again, I'll say that we built our model in component parts. Then we looked at what are other bulk mineable scenarios in the area, and there's only one that's in production that's very similar to us, and Goldex is in production, but it's a little bit of a different operation. So I'll again talk a little bit about Young-Davidson. Young-Davidson is currently has a resource of about 3 grams a ton. We're a little bit higher than that, but ours is a resource, theirs is a reserve. But based on those numbers, looking at the annual production, doing the simple math, we came to the conclusion that it makes sense. So it was a test of our detailed study, and it checked the box. As far as all-in sustaining costs, most of the unit costs are impacted by the grade of the proposed production at Fenelon. And so we back-checked that, and it made sense. So, it's a good proxy. It's a great project. And our ore is in a similar 1 kilometer cube. So there's great parities that, we look at. Moving on to our second deposit is Martiniere. Martiniere isn't as advanced as Fenelon. Martiniere looks like it could be an open pit. It's been drilled down to about 400 meters, but a lot of the drilling is above that. This year's program is focused on about 13,000 meters, a little more than half of our budget, to look at resources and how we fill this in. Our goal is to advance Martiniere with studies and exploration drilling to be ready to put together a combined PEA, because the two projects are about 30 kilometers apart, and we believe that there are significant synergies between the two projects that we would look to unlock as we study this further. In addition to the two deposits we have at Fenelon and Martiniere, there's a large land position that we continue to explore, looking for new discoveries. If you look at our program this year, we're planning on spending $21 million, 13,000 meters, as I discussed earlier, on Martiniere, about 5,000 on Fenelon, and 5,000 on regional targets, looking for other discoveries. And the areas in yellow were the areas we had in mind looking for discoveries when we put our budget together last November. And the whole program is success driven, so that may move around a little bit as we learn more about this property position. But it's quite a big and exciting property position. So the investment thesis with respect to WallBridge is, one, we're looking to unlock a central milling opportunity between the two projects that hopefully will improve our IRR, our NPV, and our MPV to initial capex ratio. We have a great technical team. When Attila left the team to pursue another opportunity, he was our VP Exploration. We brought in Mark Peterson. Mark I've known for many years. He's been involved with Calibre Resources, with New Gold, Metallica, and he started his career with Lac Minerals. A lot of similarities to exploring in northwestern Ontario than it is in northwestern Quebec. So great experience in handling glacial overburden and trying to find these new discoveries. The tech team is strong. Our studies manager has many years of experience. Our geo team at the site is young, energetic, and Mark will be able to mentor them and provide guidance. We couldn't be in a better location than the province of Quebec. One of the assets of the province of Quebec is, or having a property in the province of Quebec, is the refundable tax credit regime that's currently in place. Every year for non-flow-through funded, Quebec flow-through funded exploration expenditures, we get a cash refund when we file our tax returns of 38.5 cents on every dollar spent. So based on our filing our tax returns, which we did a couple of weeks ago, we're looking for about an $8 million refund for the 2023 tax year. It's subject to mandatory audit, so last year we got our refunds in September. But what that does is, close the year with 29 million in the bank, almost 30. We got a program of 21, leaves us rough numbers 9 million in the bank. 8 million comes in the form of refunds. and we've got a good start to a 2026 program. We will figure out how we continue to advance the project as the year unfolds. As far as results, the Fenelon drilling is completed at present. We are waiting for some assays and are looking to provide results to the marketplace later this month. And the Martiniere drilling, which includes exploration drilling as well as metallurgical drilling, we're looking to complete a metallurgical sample this summer, and that will be the first phase will be wrapping up, and which will provide the information or the materials for the MET sample. So with that, I'll conclude the presentation. I usually ask for questions, but I've got this little question box here, so I will continue onward. The 2% Grosset royalty meaningful? We own a 2% royalty. It was part of the consideration for the spin out to Archer Exploration. It's a very grassroots project, so at present it probably doesn't have significant value, but it's something we'll hold on to, and it could be a chip at the right time to bring some money in the company. Sorry, just struggling. When do you expect results from phase 1 of the Martiniere drill program? Later this summer. We should see those results. The challenge we have right now is assay turnaround time is 6 to 8 weeks. I think some of the third-party providers are challenged with employment levels and getting the best of the best to provide us the numbers we have. I got a question saying, how do you imagine Martiniere's impact on the combined PEA? Will Martiniere potentially add similar open pit material operations in the early days with the potential to go underground in the future? Right now, we do believe that Martiniere will be a combination of some small open pits combined with a couple of ramps, but that work is ongoing and we're in the very early stages, but we envision it to be similar to Fenelon, but probably not bulk mineable, but with an underground component and a small open pit component. What do you see improving share price and confidence? What I see is right now the current PEA has an NPV of $720 million. Our market cap today is about $100 million. Under normal market conditions, we are grossly undervalued. We need to keep advancing the project. We need to keep de-risking the project. And we will eventually get paid for that. And so we will continue on, and hopefully we get more institutional involvement in the junior sector. And gold prices are moving in the right direction, although we had a bad day yesterday. I think there is confidence coming back, and hopefully that will lead into the improved share price for all of the juniors out there. And so that comes to the end of the questions I've received. So with that, I'd like to thank everybody for attending. Thank you for your questions. And I look forward to, updating you in the future. And our numbers are on every news release. So if there are further follow-up questions after you've had a chance to listen to the website,